Okay, folks, thanks for joining me again. This is the second session of September 22nd, 2016. Before we get into it, I'm introducing a new way of reaching out to you for invitations to the live sessions. The reason why I'm going through the forum, number one, it is a record of me sending the invitations to your email via a Twitter. It's a record saying that you did have access to the live sessions every day. Whether you joined them or not is not important, but the access was available to you. The recordings are made available the same day. Secondly, I hit capacity and people were telling me they couldn't join this morning, and that's impossible. So what's happened is someone's taking the Twitter link and sharing it with someone else. So I don't know who it is, to be quite honest with you, but it needs to stop because we're we are trying to be as fair as I possibly can in terms of making it accessible to everyone. But for some of you, you're still abusing it, and you need to stop it. Okay, so the the topic of this afternoon, okay, is going to be specifically dealing with the tweet I sent out at the immediate end of our morning session. I went over to the British pound chart, and we saw a low resistance liquidity run setting up. But I quizzed you all via Twitter, and I asked you, would this be a low resistance or a high resistance liquidity run? Now, looking at the chart the first time right from Twitter, if you haven't been studying, if you've been unable to catch up with the recent videos, and don't worry, it's no rush. We're going to see a lot more of this stuff as the months go on. But if you have seen the material thus far, you know that some of the characteristics that lead up to defining a high resistance liquidity run and a low resistance liquidity run is starkly different. Okay, there's going to be very little resistance for price to move through on the upside for a low resistance liquidity run above the marketplace running buy stops, and I'll explain all this as we go. And for a resistance, high resistance liquidity run, there should be a lot of price action that it would have to trade through. And we're going to show why this today was a low resistance liquidity run. And for sake of those that are here live, I'm going to ask you, if we're trading and you are looking for high probability setups with velocity. Now, velocity is how fast you put your money in, and it goes to work for you, and then you can take it back out with a positive return. If we're looking for those types of setups, are we looking to trade high resistance liquidity runs or low resistance liquidity runs? Low resistance. We want very little resistance in us reaching our objectives. Now, there's going to be several conditions that I trade in, and this is one of the easiest ones you're going to get. I mean, this is the type of trade that pretty much materializes every single day. So for some of you folks that are here that only have enough money to pay for the first month, and I'm not trying to belittle you and say that you're poor or making fun of you. I'm just saying that you don't want to invest in the education here. You're only going to come here for 1 month and do what you got to do. I'm going to give you something so that way you can go home and still be able to do something, okay? Because I want you to leave here in good spirits. If you only came here for 1 month, you'll have something that, to hang your hat on. This setup occurs every single trading day, okay? In your notebook, every single trading day, this pattern occurs every single day. Now, the degree of how many pips are available are going to be dependent upon your ability to discern how far the stop rate will be, or if it's going to be a complete blowout and it may continue to keep on running. And I'm going to show you how that's not necessarily important, okay, because all we're looking to do is make pips. All we care about is making the next move and be a part of it. That's all. Okay, we don't need to have all the entire move. We just need a nice chunk of it. So here's a question I'm going to ask, and in terms of like a poll for the room, and I'll give pretty much the majority in what I see and observe. What would you say a reasonable daily objective? Now, remember, I'm not teaching you all to trade every single day. I'm just showing you how to find setups every day, and you weigh these setups to see if it fits your risk criteria and if it pays out. What would you say the minimum expectation for a daily setup would be for you? Lots of 20s, couple 40s, lots of 20s and 30s, 25s. Very good. Yeah, I would love to get 1,000 pips too, but that is not happening. The yeah, we got a respectable range between 20 and 30 pips, and I'm here to tell you that that's absolutely doable. Okay, if you watch the majors, that means you're looking at all the dollar-based crosses. That means pound dollar, Aussie dollar, euro dollar, Kiwi dollar, US CAD, US yen, US Swissy. If you just watch those pairs against the dollar, you'll have no problem finding a setup every single trading day that yields 20 to 30 pips. The problem is, just because it can potentially yield that much in terms of pips, how much risk is directly related to that setup? Because they'll all offer that and sometimes more, but the risk associated with those trades sometimes are equal. In other words, 1 to 1. Sometimes it's $2 risk to make that 20 or 30 pips. It's hard to define that without having a foundation. So you need to be able to add some things to it, but as a kind of like a going away present for those that are getting ready to leave us at the end of this month, this is a low resistance liquidity run. And the conditions are this. We mentioned last night, let me get my questions box out here. So I cannot see your comments or questions. So if you're asking or saying anything in the questions box, I will be ignoring you, but I will capture the log in case there is something that's important in terms of questions, and I can bring that up in another discussion. In case you haven't, if you've been wondering, I have been utilizing that. So when I talk about certain things, I'm not just ad-libbing and going along. I'm using some of the things you actually have asked in the live session. When I log the questions that you're asking or comments, I'll throw that in there while I'm talking about the markets in the next session. So last night in the recording and the live session we did, the daily chart, we noted that we would probably run above this high in here and close in the range between this candle's low right here, this low here, and this candle's high. So we would probably reach up into that. And the reason why is because we could not get lower than this down candle, which is a bullish order block. What makes it bullish is the fact that it ran away from it quickly. We know banks buy when the market trades down. So when markets trade lower, banks buy. When markets trade higher and then sell off, like we see up here, you know that they were selling in that big green candle. And we can see clearly that that was, in fact, what took place. The market came all the way back down, hit the same level that started this down candle, hit it, respected it, and bounced away. Yesterday, we also saw the unwillingness for the dollar to get back above a specific level we had in mind to allow us to come to the conclusion that the dollar would be bullish going into the rest of the week. And in fact, it gave us the indication that it was going to be bearish for today and potentially into Friday, which is the reverse of what we would expect to see in the British Pound USD, the Euro USD, and all the other foreign currencies. Since we were primarily looking for this range here, we had an objective. We were looking for the run on these stops above this high at 130.95, and I'll show you what that looks like here. High comes in at 130.94, so the stops rest at 130.95 to 131 big figure. Okay, so right above this high, stop loss orders in the form of a buy stop, protecting short positions. The market's been going lower. We understand that traders are going to do what? They're going to trail their stop loss right above a recent high. This is the most recent high. Price hit the order block down here. We know that it's most likely going to be sensitive there, but we don't ever know for certain that it's going to bounce. We did get that yesterday. Price was unwilling to go lower and then closed up on the day. So we identified last night before the fact that we would probably trade up into this liquidity gap right up in here. So what makes this a liquidity gap is the fact that the market traded aggressively down, and whenever that does that, we look around in this range. We see the low of this candle here, and we see the high of this candle here. So the market in this entire candle, it has traded between this low and up here basically 2 times, between the range of this low and the candle's opening. So we had 2 times the market traded in that area. So that's efficient versus this area where the only time it's traded was down here and made one single pass and then came up one more time. This could have came all the way back up here to this low. It didn't. It only stopped right there. So that's why I'm defining that shaded area. Let me move this over so you can see it. That's the low of the candle right there. Okay, so we were expecting this stop run above this high and further expansion on the upside. Now, this low right here on a daily chart, which is what we're showing on the left side, we have another chart to the right, which is the same currency pair, the British Pound USD. This chart is a 15-minute time frame. The only thing I did was I've taken the level here, 130.92, and transposed it over to here. Let me make sure I got that on the right one now before I get crazy. The high comes in at 130.94, and that's the level we're showing over here, 130.94. And that high right there is, in fact, this very high on the daily chart. So in a 15-minute time frame, all we did was compress it down into 15-minute bars. So everything on this candle, everything on this chart here, every individual candle represents 15 minutes. But we're specifically dealing with this level, 130.94, which is this high on the daily chart, 130.94 on September 19, 2016. The market traded down. All of this right in here, these bounces are occurring right at this level down here. So this high on this candle comes in at 129.48. So if we put a level on 129.48, okay, so we can see that price hit that one time, rallied away, hit it again, rallied away, almost came down to it, but didn't. Where did it stop at? At the down candle right here. Remember what happens when the bank comes in and buys? They buy when price is dropping and price rallies away. It breaks this short-term high. When it rallies up and it comes back down, there's your buy right there at that down candle. Draw that out in time. It hits it here and hits it again and rallies away during FOMC. When we see this, and this is occurring on the daily chart, and again, what we showed with specifics relating to British Pound USD is exactly how I trade, exactly how the banks trade. They use these reference points on the daily chart. There's not 1,000 setups a day. There's not 1,000,000 scalps intraday. Okay, it's one good solid setup based on a really sound principle arrived at trading off of a key level on a daily chart. If you frame all of your analysis on the daily chart and transpose those ideas onto a lower time frame, 15-minute basis, you'll have all the setups you'll ever want as a trader. So we know that price is most likely going to run away from this level down here, 129.48. That's this here, 129.48. So if it's going to rally on the daily chart, what's it going to reach for? We've identified last night this high on this candle coming in at 130.94. So the stops are going to be resting above 130.94. So again, this candle is the 19th of September. If you look down here, the 19th of September, that's this high right here. So I noted the X, that's where the stops are, above the marketplace. What kind of stops are they? They're buy stops because the market's been trading lower. So the market makers are going to make a run on those individuals that are short and then try to knock their positions out. It doesn't matter if the market's going to continue going lower or higher. That's not our concern. We are only trading against the liquidity that's in the marketplace. So if we know that this is only one time that it traded up here and then moved away, and that's seen right here, okay, there's no other stiff market action. When it made that high right there, it only went up there briefly and traded away. One little tiny little retracement in here and sold off again. There's no real considerable resistance up here. None. It's only been one little spike up. It trades aggressively away from it. Tried to get up there one more time. Nah, ain't happening. Went lower. So this entire spike up into that level is very low resistance. Very little resistance to get up there and hit that level, and it ran away. Now, because we have this old high noted, again, think about what I gave you in terms of last week's, what you should be focused on right now in that tutorial. I told you to focus on old lows and old highs. Look for areas where the market runs away quickly. It does that here, okay? And it doesn't want to stay there long, and it tries to get up there, it doesn't want to go there and runs away. Buy stops are going to be resting above here. Even if we didn't see it on the daily chart, we can see clearly that the market has dropped down. So if we're short, or traders in the market are short, their stop loss order is going to be above this high, and their stop loss order is going to be above this high. So they don't want to be in the positions if the market goes above this high. They want to get stopped out and take whatever that loss would be and prevent any further loss if the market keeps going against them. Well, the highest interim high would be here, which was this high here noted on the daily chart. So there's going to be more liquidity in the form of buy stops protecting short positions on traders that are short, trying to make money going lower. They're protecting those positions with a stop loss right above that high. Daily highs and lows, again, are gold mines. They are hit every single day. Every single day. One major or two runs out a previous day's high or low, and that is an amazing, easy bread and butter setup where you can get 25 to 30 pips every single trading day. Now, again, I say this because it allows you to practice. It is not an invitation, and it's not, I'm not trying to carnival bark you get in every single trading day trying to take a trade with live funds. That's not my intentions here. But I'm showing you that there is such a high degree of reoccurrence and these patterns forming. And I'm telling you, if you study this, and don't take my word for it, I want you to go through the charts and see if that's not in fact what's going on. Every single day, the banks make a run on previous day's highs and lows in one or two majors. And that sets up the undertones of what the market's really doing. And I'll teach more about that as we go along, but it gives you like an inside track as to where the market makers are going to push price across the entire board, in other words, all the pairs. But you have to find out where the most recent liquidity runs are being taken place, because that'll give you a lot of insight about where their book is relative to the dollar. And I'll explain all that as we go into the months later on in this mentorship. But for now, just make notes of the things I'm discussing here. So we start today. Okay, we have yesterday's trading, the 21st. Okay, and then 0 GMT, 8 o'clock in the evening, my time and New York time. We start here. Okay, and price starts to track a little bit at a time. And all of a sudden, we have this vertical line here. This vertical line delineates midnight New York. That's true day, and that's when all the banks come online, and we're expecting the daily high or low to form between 2 o'clock in the morning and 4 o'clock in the morning New York time. So if we're starting the day at 12 o'clock down here, okay, we know there's stops resting up here. We know that the likelihood that the dollar is wanting to go lower. Dollar's been closed low yesterday. We're going to most likely reach below these lows down here, and we're aiming for this 94.85 to 94.80 downside objective. So if that's the case, we're seeing weakness in the dollar, or anticipating weakness in the dollar. What are we expecting for the British pound USD? For this pair here we're looking at, British pound USD, we're looking for higher prices. Now, we're not just guessing. We don't lay all kinds of Fibonacci or harmonic pattern things on our charts and label them with a whole bunch of nonsense. We're looking specifically where the money is. Where's the money at for this particular currency? And it's going to be in the form of the buy stops that are resting on this old high back here. And again, the premise is because the market for the British pound USD is on the daily chart, it's been trading lower. So we know that there's a book that is heavily net short, and it's going to be in the form of the funds. So they're going to take those stops that are being trailed as the market makes lower lows over here. The stop loss orders start building up above a recent high. We had a swing high here. The market tried to go lower, and then we came right back off that low here. So this order block, 129.48, which is that down candle here, right before we exploded up, that sets the tone for them to shift gears and make a run for the liquidity, or the orders, the stop loss orders, above the marketplace. So since we're here, we already know in 1 second, all it takes is, okay, we know that the dollar's bearish. foreign currencies should be bullish. Where's the liquidity? Immediately, we're looking for it over here and over here. Okay, so we have two areas of liquidity that we'll be watching. This high, and obviously where markets should be drawn to is here. So watch what happens in price. We already know by taking that high and drawing it out in time, put a horizontal line on it. Okay, once we have that, we can identify in advance what 10 pips above that line would be. Here's a 10 pip grade stop sweep. Okay, in other words, what I'm saying is this level here, 130.95. 10 pips above it will be 131.05. Okay, so that's 10 pips from the high that I'm noting right here. 10 pips above it, and then there's 20 pips above it, which would be 131.15. So we want to look for moves that are 10 to 20 pips above old highs or 10 to 20 pips below old lows. That's how the algo sweeps for stops. Okay, in other words, we're expecting price to expand up to here, very minimum hit this level, then the next level would be 131.05, then the next level would be 131.15. We know this when price is down here. Okay, now knowing where the market is most likely going to reach for, and this is what I refer to that when I say knowing where the market wants to be drawn to. Okay, where is institutional order flow leading us? Where's price indicating that it wants to go to? It wants to go up to these highs here and here because that's where orders are resting. Now, if the market has responded as handsomely as you see down here, it can't get below this 129.48 level, which is this daily order block right here, 129.48. It can't get below this down candle's high. 2 times it tried to do it and repelled yesterday. We know now after the fact that the market has rallied up aggressively and took out 2 swing highs. So the market is predisposed to go higher. You do not need to know every possible entry. You just need to know where the market's most likely going to be drawn to. We didn't do anything during FOMC yesterday, not one thing. We just observed. All we did was watch the price, and we were waiting for some insights so we could look at price today and going into Friday for directional premise, and then also know where the most likely will target liquidity. So if we look at what's transpired here on the cable, new bars are forming. Okay, all of a sudden we get a run here. This candle takes off during 2 o'clock in the morning New York time. So that's London open. Then the market trades down right into the bullish order block right in here. By itself, that's a buy. Right there, that's a buy. And you could take that long, get long there, and expect it to run up to this level here, 130.95, then 131.05, and then 131.15, because the liquidity is above these highs up here. There's no resistance. It's only got one little high here to trade through, and it already blew through that during the London run. It hit that and came all the way back down, and then you want to watch these down candles, these little black candles. Price should support that. Now think, if you're going to be long in London, if you get a positive response in price, like we see there, price starts to run higher, do not cram your stop loss underneath the lows or trail it up during London session. You cannot move your stop at all until you get to 7:30 to 8 o'clock in the morning New York time. You have to have some of the daily range behind you before you trail the stop. If you can't do that, you're going to get knocked out prematurely. Okay, it's going to happen to you. It's going to happen all the time. The market has a tendency to drop back aggressively in London and sometimes do a double sweep on stops. We see the response here at the down candle, so we know that the market makers are capitalizing these bullish order blocks. If you were buying right here, okay, on these order blocks, where would your stop have to be? It had to be below 130.30 to 130.20 down here, because this is your next order block. So it's got to be below here. So your risk is between here and here, roughly 15 to 20 pips. Okay, so if your stop loss order is down here, as soon as you start to see response, you do not run the stop up real quick. That's not what you do. You have to assume a little bit of risk. You don't focus on what if the market goes down here and stops me out. You worry about, does the market show indications that it still wants to go up here and reach into these levels? Because there's very little resistance up here. It's low resistance. It's only got one little high here and one little high here. And it's all ranges. It's all it's been. All quick runs lower. That's not stiff resistance, very low resistance. And we know that the buy stops above these highs. This one's already cleared out, so the next area of liquidity is here. So watching price again over here, it runs out and makes another higher high. So now, again, my question is do you feel the impulse looking at this? If you were watching this and you were in a chart live in a trade, would you feel the impulse to trade your stop from a lower level down here up to a higher level to lock in profits? Most of you probably nod in your head, yeah, I would do that. Absolutely, I would do it. Because you're fearful, and the reason why you're fearful is because you don't have enough experience to know that even though that this could come back down again, it could hit this order block or it could sweep the low. Market does what? Trades down, hits the order block right in here. Now, this is actually another new buying opportunity. You could take that as a long. Again, the same stop though. It has to be down below this down candle. It has to be outside of this because this is too clean. It's too clean in here. So there's going to be liquidity resting below that, and it's certainly going to be below this low here. Market does what? Drives right down below that low. Now, watching that, you'd probably be very scared. But it's really only moved about 11 pips. But 11 pips in quick, sudden price action, and it's against what you expected to see, will make you very fearful. If it would have hit your stop loss order here and you trailed it up, if you got stopped out right there, you're not thinking, let me get back in. I guarantee, I bet you $1 million, you're not looking to get long again because you saw that run down, take out that low, and now you're not thinking about getting long. And that's exactly what it's designed to do. It's designed to instill fear. And as soon as you feel fear, think about what you're fearful of and reverse it, and it's probably what's going to happen in the market because it's designed to capitalize on fear and greed. The next candle, we don't go any lower. Next candle, we don't go any lower. What is that? What's that pattern right there? It's a swing low. So we have a low with a lower low and a higher low. Each low in these three candles, one being in the middle, each having a higher low on either side of it. Rallies up, rallies up. This high here has liquidity above it, and then the next area is above this high here. Right here, what's going on? We have this down candle that ran the stops below the low. So this down candle, think about what I've been saying for years. Smart money, the banks, okay, they buy when the markets drop down. You know they buy when they take out a previous low and it rallies away. That's an easy trade. Very, very easy trade. So if you see the down candle that drove underneath a previous low, you know for sure that's a 95% likelihood that that's a buy. If you can get into the market long inside this candle, in other words, in the range of this down candle, or very close to it, you have a loaded deal that the direction of premise is going to be on the upside because the low had been taken out with this run below it. And it's a down candle that drove right through it. So if price is consolidating out here, look real close at what's going on. Don't pay attention to the bodies. Look at the wicks. They're dipping, going lower, going lower, going lower, going lower. They're just eating into the top of this black candle. Okay, all this down candle, all they're doing is every time it's going down here, they're buying more. They're buying more. They're buying more. They're buying more. All below this candle's high, all in that little portion of that candle. All this is new buying. Right at 9:30 this morning on the economic calendar, we had a medium impact news event that was due out for which pair? The British Pound USD. Right before that happened, I sent you out a tweet and I asked you, would this be a low resistance or high resistance liquidity run? I didn't have it like this. I was asking what this would be. In other words, to get up to this level here and run these stops over there, would it be high resistance or low resistance liquidity run? And I left it up for you to watch real time. As soon as I put that tweet out, I bought it long because I knew I was sitting right on top of the order block right here, and expansion was so one-sided it was going to go up and run the stops. Market dropped one more time. What's it dropping into? That order block right there, right there. Immediately jumps up. Where's it go? Right for the stop level, 130.95. Market drives through again, all the way up through 131.05. Falls short of 131.15. I wasn't sure I was going to get that level because I was actually, if you look in the tweet I gave you, you can actually see my limit order was right at 131.15, and it backed off a little bit. I was like, okay, well, I'll collapse it here and just be done with it. But ultimately, it came up and hit it later on, about half an hour later, and swept that level. Now, it went 20 pips above this old high. That's all you need. That's it. There's nothing else you require. I took 2 stages of the trade out. I took 3 standard lots off at the first run above the high here, and then I took the remaining two lots off when it was just a little bit above here. And ultimately it went up and hit 131.15, but nonetheless, when we see that, we expect the market to not want to hold on to those levels and retrace back because of time. It's moved up into between 10 o'clock and 11 o'clock in the morning, and it's fulfilled the numbers. In other words, it's called filling the numbers, rather. The numbers are here. This is where the liquidity is on this old high. So if the market runs to that level, and that's what we identified last night anyway, once it hits that and it's achieved time of day between 10 o'clock in the morning and 11 o'clock in the morning New York time, you're combining what? Time and price. So you've met the objective that would be reasonable for the day, and it's the time of day when London is closing between 10 o'clock and noon New York time in the morning. That's when London's getting ready to go off session. So that's only going to be remaining active relative to North American traders in Canada. So we take our profits and we move to the sidelines and you just wait. Now, how much movement is that? At 10, 20, 30, 40, 50 pips. 50 pips. Just like that. Easy 40, easy 30, no brainer 20. You're targeting previous day's highs and lows. All you need to know is what the consensus is on the dollar. Is the dollar going to move higher or is it going to move lower? Or is it going to stay in a tight little range? All of those conditions have specific setups that I'm going to give you. This is the easiest one. If you know dollar's going lower or likely to go lower, you just look for pairs that have liquidity pools, which is what this is. That's a liquidity pool. Buy stops resting above an old high, defined as we described it last night and so far in this video. And they're going to want to drive price up to that level. Now, not just to that level, we're going to reach 10 and 20 pips above it. How many times since we started this mentorship last week of August, we had a group of folks join, and we have been talking about this on a daily basis, and for years I've been teaching it in my free tutorials. The markets go in grades of 10 and 20 pip sweeps. That means above old highs, it'll move 10 to 20 pips in movement, and then ultimately come back down. Price came back one more time, hit the previous high, and look at the response so far in there. That's not random. Okay, it's not random at all. So what are we looking at here? If we define the day, okay, we have initially starting at midnight in New York time, the market slightly sideways and expands, comes back, bullish order block, rallies again, comes back, runs the stops, then expands, makes the high of the day, where we indicated, okay, with a low resistance liquidity run. All the framework that I give and all of the stop running criteria, nothing's changed. I didn't make it 27 pips for an example here. I didn't make it 14 pips. It's static. It goes in 10 to 20 pips. Now the question is well, what if it only goes 10 pips? That's why I took profits where I took profits at my first portion. I had 5 lots on. I took 3 lots off once it got into the range of taking out 10 pips above this old high. So when I went above 130.95, I took profit on 3 of them. The majority of the position was taken off. And then I moved my stop to just a little bit above break even. and I didn't care. I wasn't worried about the stop. I'm worried about, does it have the willingness to get up there and get to that 131.15 level? And initially, it looked like it failed, and I was like, well, I'm just going to collapse it here and be done. I don't care that I didn't get that last 7 pips. I could care less. Now, my question is this. If you're looking at this, okay, and say you can anticipate these types of little moves. Okay, these are little bread and butter type things. These things are happening all the time. When I'm in the market scalping, this is all I'm looking for. Obvious, no-brainer, where they're going to run the liquidity out. You get in there, you take your 20, 30, 40 pips, done, and move to the sidelines, or go do whatever you want to do the rest of the day. You don't need big range days. You don't need these extrapolated price moves higher or lower for multiple days. That's not what you need. If you can trade like this, going in and surgically strike the market and take out specific price levels, knowing in advance where the market should be drawn to, like magnets, okay? This price level back here was like a huge magnet, and price is just like a bunch of paper clips. It's being drawn up by magnetic pull of all these orders. Why does it want to get above here? Because the banks that are long down here that bought, they want to get those orders that they went long at a profitable position to sell. They want to sell it at a higher price. So they have to market to a willing pool of buyers. That's why the market always goes above a previous high here and here, because when it does that, they ran the stops here. They took a little bit of the positions off by running this old high. Let me show you here. This high was ran out in the initial run on London. It only went a couple pips, 10 pips. See the level here? 130.62, 10 pips roughly, and then comes right back down, recapitalizes an order block, and then runs again, right into an order block, runs. Now this high here, watch this. The high comes in at 130.75. So 10 pips is 130.85. 20 pips is 130.95. Watch this run that goes through this high. Just about 10 pips just falls short. Same thing, 10 pips above here, and then 20 pips above here. Watch. Boom. In grades of 10 to 20 pips. When you understand this, it gives you a huge amount of advantage because, number one, it tells you a defined range in which you aim for when the market runs in your favor. You don't get pip drunk. You don't thinking, well, I was only trying to make 25 pips, but this thing looks like it can go 900 pips. Or I'll probably turn this into a 3-month trade. We don't do that. We know exactly where we want to get in at. We know exactly where we want to see the market go to. And when it gets to that level, we'll take a large portion off early, and then we'll see if it has a little bit more room to go. If it doesn't show a willingness to go with strength through where we thought we were going to see it go, then we take the remaining portion off and or tighten the stop loss up. And look at the responses here. I mean, look at that. It's beautiful. That's textbook algo. You can't get any cleaner, any more clean than this type of price action. It's perfect. Absolutely pristine. So if we're going to define trades where we know that the probabilities are highest in our favor, we're looking for opportunities where the market can run out a previous day's high, and it doesn't have to be yesterday's high. It can be the weekly high. Okay, or it could be the weekly low or the previous day's low or the lowest low in the last 3 days. Why is that important? I'll teach you all those types of things. But for now, just know that just because I'm not giving you a plethora of trading signals that you're looking for, I'm giving you context and the framework to find these things on a daily basis. Every single trading day, we have seen something in the form of 20 to 50 pips every single trading day, in advance outlined. Now, I don't trade every single day, but I'm showing you if I was a nut job, if I was a junkie that I had to be in here every single trading day, I would be in here trading my rocks off, okay? I would be in here doing all kinds of stuff. I don't want to be in front of the charts all that much. The only reason I'm in front of the charts this much is because I'm teaching you. You're paying for my time, so therefore I'm in front of the charts. So if I had to be in front of the charts, if I was forced to do it, these are the types of trades I would find every single trading day. Every single trading day, no problem. 100 pips a week is absolutely easy, 100% easy, consistently done every single week. Now, it ain't going to be easy for you. Initially, you got to learn a lot of things. You got to learn a lot about yourself and got to go through growing pains. But you will get very easy at finding one trade a week where you're making 25 pips. That's where we're starting in month 2. We're going to go in hunting one setup that pays out 25 pips, and we're going to do it 4 weeks in a row. We're not trying to catch 1,000 pips. I'm going to show you how easy 25 pips net every single week is. And I know some of you are thinking, oh man, this is rip-off, man. I'm not here to learn 25 pips. If you can't do 25 pips, you're never going to find 100, and you're never going to find 500 a month. And that's where you're going to get to. You're making 500 pips. At the end of 12 months, you're consistently raking in 500 pips or more per month. But I have to start you small in an area where you can grow from. And easily done 25 pips every single week. If you do 2% risk on that, that's over 100% return on equity every single year. And I don't care what you start with. And I showed you back on Baby Pips in 2010, if you start with $1,000 and you can grow your account 100% return over a year, not in a month. You're not trying to double your account in a month. Double your equity over the course of 1 year. And that's easily done by 25 pips net at 2% risk every single week. It's more than 100% return. That's 6% compounded interest every single month. That's absolutely gravy train easy. Cakewalk. You can do it in your sleep. Trust me when I tell you that's easy. Now, the problem's going to be is you're going to be able to do this very easily. 25 pips is going to come like nothing to you. And that's going to force this impulse in you, well, I want to do more. You need to keep that at bay. Let me dictate the grade of what you're aiming for as we go deeper into the mentorship. If you submit to this, I promise you 100 pips a week is going to be absolutely doable for you. I don't personally look for 100 pips. All I'm looking for is 50 to 75 pips a week. I'm looking for one setup that'll pay me that, and that's it. I'm done. Because I'm living my life. I'm doing what I want to do. I got children, I have family, and all that stuff. I don't need all that much to put money at work. But because you're a developing trader and you're wanting it, okay, and once you acquire the skill, you'll see that you don't need to do that either. Trust me, you won't want to trade this much. You'll just know when your setups are there that you like the most. And then they're really cherry, they're really perfectly lined up. That's when you'll put your money at risk. And then you'll be able to call other moves, and you'll look at other things on the internet, people saying they did this and say they did that, and you'll laugh at them because you know they're talking at their rear end. But you know that you'll have the ability to go in any market, in any asset class, any time frame, and go in and harvest pips. And what you allocate behind those pips is a direct relationship to what you're going to be earning in terms of percentage. And you need to be focused on that. Not money, not I need to know how many pips I earn. It's got to be this much every week. No, you don't need that. You need a percentage return. And I believe personally that 8 to 12% a month is absolutely your 6 months goal. That's what your 6 months goal should be. You should all be hitting to 8 to 12% per month. I think that's a realistic objective. When you get to 9 months in, you should be anywhere between 12 to 16% a month. When you are in the latter months, you're doing 20% plus every single month. And if you are not doing that, I failed. Okay? It's just that simple. You're going to learn exactly what you're supposed to do with your money. You're going to do exactly what I tell you to do and nothing else. You're not going to add things to it. You're not bringing your favorite indicator stuff. You're not going to bring your friends' discipline. You're not bringing supply and demand into this. You're not bringing in Ichimoku. You're not bringing in cloud formations. All that. You're not doing any of that stuff. You're only doing the things I'm teaching you. Nothing else. Nothing else exists. It's all nonsense out of what you're learning here. Focus on just the things I'm giving you. Forget everything you know. Leave it at the door because it doesn't work. The things I'm going to show you are precise. They deliver every single trading day. It's the same thing. It's the open, high, low, and close, and understanding why the bank should push it higher or where it should be pushed lower. That's it. You either have higher objectives or you have lower objectives. And if you understand what a liquidity pool is, and it's simply just buy stops or sell stops, okay, and why those stops should reside where they're at, once you understand that, that's an easy, no-brainer, bread and butter trade. And it happens every single trading day. Every single day. One of the majors is giving it to you. because not all pairs move exactly step by step in tandem. And that's why correlation works. You get people like Steve Morrow that learned from me, says that correlation doesn't work. I didn't teach him everything I knew about correlation because actually I had to learn about correlation later on. I know correlation now. I understand it. So when we see these things and we see that they repeat over and over and over again, the long and short of it is it gives you an edge. Just because a pair isn't moving right now doesn't mean it's not priming to go later on. That's how these crosses work. To make the euro pound go up and down, they have to manipulate the majors in the euro dollar or the pound dollar. So when that manipulation is done, then and only then, the cross between euro pound is allowed to move. And we're going to cover all that stuff. There's so many things to get into, but the main thing is I simply love the fact that you're all experiencing on a daily basis something every single trading day. And if that's not building your confidence, not your impulse to trade every day, if it's not building your confidence that you can find something every single day, and that way, don't worry about missing any moves right now. The first couple months, don't worry about trading live money. You shouldn't even be doing it. Focus on learning this stuff. And if you do that, I promise you, you will be leagues ahead of retail. You'll be well beyond what you've ever imagined, even for what you think you're going to learn at the end of this mentorship. In the first 3 months, you'll be well beyond that. Because I said, you don't know where you're going. I know where you're going. But when you submit to it, I promise you, you will have everything and more that's necessary to build wealth, to be consistently profitable. You won't fear taking a loss. You'll know the next day there's going to be another setup, and you can get that loss that you took right back. It's not a big deal. Drawdown does not exist. Okay? You have cost of doing business. That's it. We don't look at long, drawn-out periods of losing. We just know that there's possibly going to be a trade that we take. Human error is going to come in, and you're going to take a loss. Boom, no problem. Take that loss. What is it telling you? Is there still a viable reason to see that price go higher, or should you move to the sidelines or reverse? There's a decision process that you're going to be taught. And once you understand these things, it's a flowchart perspective. You go into the market every day with the same starting point, and you ask yourself these specific questions. And based on what that decision is, you go to the next stage of your analysis. And then you go to an action point where, okay, you either take a trade or you wait for this condition, then you take a trade. Trust me, you have no idea how easy it's going to be, but you have to know the individual components. And you have to see it every single day leading into these things. Once you see it, you'll never forget it. You can't forget it. You can't unlearn it. Once you see it, it's always going to appear in the chart. It doesn't hide from you anymore. It's obvious. It's so obvious. It's ridiculous. But what's going to be crazy is you're going to look back. And I'm saying this in closing. You're going to look back and see where you looked at price charts before, and it looked like it was a foreign language. It looked like there was no rhythm to it. It's all chaos. It has no real reason why it's doing what it's doing. It's chaotic. It's gambling. When we get to the end of the third month, you're going to look at price charts and say, this is beautiful. I know exactly what this thing's doing, and I understand it. And I know right now is not a time for me to trade, but I know when it will be when it gets to this level. And when it gets to that level, I know where it's most likely going to go next. And if it doesn't do that, then it gives me another point of decision where I got to make a trade higher or lower based on it or move to the sidelines. You have 3 transactions to make. Do nothing, which is observe, buy, or sell. That's it. And it's going to be based on the functions of the algo, either under accumulation or under distribution, or we're going to be approaching a manipulation factor. Something's going to happen in the market where it creates a protraction in price, where it moves sharply one direction, which is the opposite direction it's going to really move in later. And once you understand these things, it dovetails beautifully, and you will have no problem whatsoever sitting on your hands, resting, and waiting for the opportunities to come to you. You won't push your will into the marketplace. You're not going to force patterns. Okay, well, I don't see anything ICT talks about, but I do see a Gartley, or I see a bat pattern. Let me just get in there because I need to do something. You will know that that's not what you should be doing. You're going to be aiming for the money. That's what the market makers do. That's what liquidity seeking is all about. That's what makes the market go up and down. It has nothing to do with Fibonacci. It has nothing to do with support resistance. It's all about where the money is. And if you understand where that money is hiding in the price charts, and it's obvious, it's so obvious, it's so obvious, you will never, ever, ever have these impulses that you have right now. Maybe you've lost a lot of them in the first couple of weeks we've been here together, and you're seeing this stuff happen every single week. There's something we've outlined or we can see coming to fruition, and it does just like that. You're seeing that, wow, if I just took one of these trades for each week, that's way better than I would have been doing if I did nothing else, or if I would have been doing what I was doing before I joined this. That's what I'm trying to show you, is you don't need much to do very, very well. And then when you're really refined, then you really know what you're looking for. When you get in a state, there's competitions out there all over the place. You know, people have all these trading contests. FXCM has them all the time. Almost like on a monthly basis, really. Once you get refined, you can go in here and destroy them. Destroy them. Absolutely just decimate them all. And that's one way you can use that desire to do a lot more, because you'll be doing it in the right context. But you don't want to have a competitive trading mindset when you're trying to grow your equity. That's not what you need to do. You need to start with a really low-end objective, 25 pips a week. It's easy, absolutely easy. And I'll be honest with you, you can manage a fund just doing 50 pips a week and just knock the socks off of the customers that you're managing the money for. They don't need to know what you're doing. They just want to see the percentage return. And if you build that gearing around 50 pips a week, your job's easy. It's absolutely easy. But they're going to swear up and down that you work so hard, you're slaving over bank reports and fundamental data and analysis, and you're probably staring at charts until your eyeballs bleed. But in reality, you're only spending about 10 minutes total. And that's including the execution and management of the trade. So, in closing, low resistance liquidity runs is exactly where you're going to be focusing in on these specific setups throughout the entire mentorship. They're the easy, low-hanging fruit. You're going to learn other setups, but this is the easiest one. The pips get bigger when you apply it to a higher time frame chart. Since this is a 15-minute time frame, I'm only looking at a daily run that was seen on the 19th of September. Nothing wrong with that. It's a respectable amount of pips, but that's a one-hit, one-shot, one-kill setup for me. This little move right here, that's it. That's all you need, and I would be done for the week. It's over. Nothing. And you can wait all week long. That's why I'm not in a hurry. If I don't get the Monday or Tuesday or Wednesday low of the week, who cares? I'm not worried about it. I'm not, making a big deal about it and yelling at my wife. I'm going to get a divorce because you caused me to miss something. I'm waiting for another trading day. I can get it on Thursday. I can get it on Friday. Something's going to give me what I'm looking for to make the amount of money that I know is consistently available every single week. Now, to a neophyte or someone that's been trading for a while, well, it sounds like you're forcing a trade, Michael. No, I'm not. I'm forcing my rear end in front of the charts and waiting for the trade to come to me. That's what I'm doing, because I know it's coming. And guess what? It may not come. But the next week, I'll get mine. And just like that, you'll get yours. So I want you to think about what I just showed you here today, how very little resistance these types of trades offer. It just guns right through it. And when you see patterns that are just basically stagnating right below an area where the market should see liquidity or run through it, aiming for an old high back here, okay? When we see this little crouching below a liquidity pool, it's the same thing as crouching below a order block. All they're doing is setting the stage for people that use just Fibonacci. And I'll share this and I'm turning it off. In closing, in 15 times. All right, we have the high here. Everybody does this with their Fibonacci, right? Optimal trade entry. ICTs, optimal trade entry, man, it's amazing. That's what this is. We have a low formed from this price low here. Swing down from this high, makes a low, it rallies up, goes right into 79% retracement level. This is a classic ICT sell if you watch the price go lower. But we didn't do that. And that's why I try to tell everybody, You don't get to the end of the game with just Fibonacci. You have to understand institutional order flow. If you don't know where the market's going to reach for the money, you'll fall victim to this retail trap all day long. Because I didn't invent 62% and 79% tracer levels. I didn't invent that. I just know when it's coupled with teaching very elementary grade students with price action, it helps them find the order block. But you don't need the Fibonacci. You don't need it. And in fact, if you use it wrong, this is what you end up getting. Because this right here, it would have looked like right here on this candle here, it probably looked like, hey man, I got it. This thing's going to go down. It's going to go down. It's going to drop right there. Starting to drop down. All right, man, I'm going to take my profit down here and I'm going to wait for it to keep on trading. No, that's where it's going. So you got to keep in context what it is that drives the marketplace, because it's not indicators. It is absolutely not indicators. It's the money. And what was resting above this old high? Buy stops. And it makes perfect sense if you understand that if the banks are buying down here, they're not going to sell their long positions here. They're not going to sell them here. They will sell them when it gets above this high here, which is what it does right there. They sold some, and then it drops back a little bit. Now they have a lot more on. They don't want to take the profits here. They're going to take them and get them unloaded up here with these willing buyers. They have long positions from down here. To get out of a long position, you're doing what? You're selling. So wouldn't it make sense for them to just make price print at 130.95 or higher, because that's where the stops are going to be, for people that want to buy? Now they're buying to get out of a short position. The banks are getting out at a profitable exit on a long. And that's what pairing orders is. That's all this is. They pair orders together. They want to put their long exits with willing buy stops, and that's all the market is. When markets trade higher, that's all it's doing. It's going up to seek liquidity to pair those long smart money positions with willing buyers at a higher price. That's it. That's all it is. And it's just reverse on the downside. And there's so many intricate details that lead to these setups that make them high probability. That's what makes this mentorship what it is. But if you just learn this one here, what I just showed just today, you can turn the computer off and there it is. Thanks. I know enough now. I can go out and carve a career. And I mean that. Absolutely. This is enough to do everything you'd ever imagine with trading. But you won't be satisfied with it. You won't be satisfied with it. You'll be wanting to do more, and that's normal. And I invite you to do that. There's so much more to learn. But don't discount how powerful this one is, because I do this one on a weekly basis. And it's so easy, absolutely easy. It's just literally like taking a candy from a baby. And I like babies. I'm not trying to be mean. But there's so many opportunities like this that occur on a weekly basis. It's easy. Real easy. Did you make 40 pips today? Did you make 30 today? It was in the chart. It was in the British pound. We outlined the level. You know how far that goes above a high. 20 and 10 pip grades. That's it. Study these things. Every single time I give it to you, study it. Because every time you watch it, you're getting an introduction to greater understanding of how price is delivered. And when you understand that, all of a sudden, one day, and like I said this morning in the morning session, one day you're going to sit down in front of the charts and something's going to happen. You're going to see something that takes place in the price, and it's going to click. Suddenly, all the confusion and just basically the confusion and the lack of clarity just dissipates like fog lifting. And you'll see exactly what's going on, just like a stereogram. There's pictures that look like you can't see anything, and you stare at them till your eyes are crossed. All of a sudden, a 3D image comes into view. That's exactly what happens in price action. You'll see where the orders are. You'll know where the money's sitting. You know how they're tricking traders to believe that that resistance level or that support level is okay to put their stop loss in, and they're wanting them to build up more orders around that level. And all of a sudden, they'll run for them. And that's all trading is. It has nothing to do with technical analysis. It has nothing to do with trend lines. It has zero things to do with a trend line. I don't care what you show me. Show me 50 million examples. I'm going to show you this happening every day. But I can show you 1,000 examples of trend lines breaking and not giving you any prognostication whatsoever. Trend lines don't give you precision. They give you guesstimations, and I don't put my money behind guesstimations, and neither should you. Know where the market's going to go, know where it's going to reach to, and here's the beautiful thing. We know what time it should do it from the beginning and the end. Time it with a trend line like that. Add time to a trend line. You can only use a trend line until it's touched, and there's no guarantee that trend line is going to hold price at bay. But we understand based on where the orders are and time of day, we know exactly what drives price. And there is nothing out there in any other trading discipline that does that for you, because this is how banks trade. You're getting the inside loop on what goes on at the banking level. And I'm going to close it there and wish you all a very pleasant evening. And we will be back at it again tomorrow at 7 a.m. New York time.